So, friends, I, Vivek Agarwal, convener ACA Study Circle, welcome you all at a very important topic of financial instrument. It is said many a time amongst professional circle that if a person knows financial instrument or understands financial instrument, he or she knows at least 50% of Ind AS or IFRS, because if you don't know financial instrument, you will not be knowing Ind AS or IFRS. And many people say that, boss, I don't have a client who is working in Ind AS, or I don't have a balance sheet to do audit of IFRS or Ind AS. But it's a matter of time as we all come forward with the conversion of AS in line with Ind AS. Secondly, most of us are investing in share market, and if we don't know Ind AS, we won't be able to decode the financial instrument or financial statement which we see. Thirdly, if we are practicing as a CIRP and getting a IR work or insolvency work and not understanding Ind AS, gives a bottleneck to decode the resolution plan received by big bidders. And if you're doing a direct tax practice or GST practice, your practice will be incomplete if you don't get proper understanding of financial instrument, or for that matter, Ind AS IFRS, because that will leave you to be giving incomplete advisory to your client. So with these words, understanding the importance of the next 2 days or 5 hours, I welcome MP Vijay Kumar sir, a man, a stalwart, a person who is representing India worldwide on financial instrument or on IFRS, a man with deep knowledge. Thank you, MP Vijay Kumar sir. With folded hands, we welcome you at ACAE. And from here, I hand over the proceeding to our very own chairman, Mohit Bhuteria ji.
Thank you, President. Thank you so much. Welcome, sir. Welcome, MPV, sir. It's a great honor and privilege to have you as a speaker at our association. And this program was conceptualized by our president, young president, I would say the youngest president of ACE, Vivek, that if you are able to learn financial instruments, then 75% of work is done. And who is better than Mr. MPV, sir, to explain us the financial instruments. So, friends, introducing MPV, sir. Sir has been a past Central Council member and has been associated with the Institute of Chartered Accountants in various capacities as chairman of Accounting Standard Board, Valuation Standard Board, Digital Accounting and Assurance Standard Board. He has been the vice chairman of Expert Advisory Committee, Financial Review Reporting Board, a nominee at NAFRA, QRB, and SEBI Committee on Disclosures and Accounting Standards. He has been an independent director on a large number of companies: LIC, Geojit Financials, Heritage Foods. The list is very long. I can go on and on. He has authored a large number of books. He has been associated with various associations, Institute of Internal Auditors, NASCOM, CII in various capacities. So he's an ocean of knowledge. I think in 2 days, we have the opportunity to hold him for 4 to 5 hours, and all members should take full advantage. Whatever queries, questions, anything and everything you can have, you can ask to a person who is an authority in himself, and no one best in, I would say, in Pan India other than MPV sir can explain financial instruments in a very simple language. So over to you, MPV sir, now.
Thanks, Mohit, for those very kind words. Deeply humbled, and thanks, Vivek, also for that wonderful introduction, both to the topic and to myself. In fact, thanks to the pandemic, the last 2 years plus, I've done my maximum number of presentations only in the Eastern region, and more so Kolkata, between ACAE and EARC, and then the Bhubaneswar Cuttack branches. So sometimes it's a blessing, you know. And also in EARC, I've been able to win some wonderful friends like you, Vivek, Mohit, and Vivek Nevatia, and Mr. Bhaskar Banerjee, who's been so inspiring, and Subodh Agrawal ji. And I think Mr. Subodh Agarwal is there as a participant here also. Greetings to you and respects to you, sir. And extremely happy to be present here. Just for my clarity, Mohit, you said 4 to 5 hours. I guess today my session is 2 hours and tomorrow someone else is doing 2 hours.
Tomorrow, sir, you also have a 1 hour session.
Oh, tomorrow I have 1 hour. Oh, so I have to divide between today. Oh, I was not aware. Okay.
Yeah.
Oh. Okay. Tomorrow 5 to 6, 1 hour I have to do.
Yeah, tomorrow you have 1 hour session.
Oh, okay. I was not aware. Okay, my mistake. Okay, my apologies. Okay. So I have to stop somewhere logically today. Okay, fine. I'll try to do that. So thank you and thanks to all the well.
Can I request all to put themselves in mute, please?
Yeah.
Sir, please.
Thanks to all the participants as well for showing their interest to participate in this sessions on financial instruments. While Vivek and Mohit, both of them said 50%, 75% of IFRS, I want to tell that as far as financial instruments are concerned, I have very, very humble request to all of you. The moment you take off from your mind that the standard is a heavy standard, the standard becomes very simple because the standard is exactly what you think. If you think it's complex, it's complex. If you think it is not complex, it is not complex. It's as simple as that. And second point, which I'd like to mention is, I think Mohit or Vivek, one of them mentioned, as far as financial instruments are concerned, there are instruments which are very simple instruments, very vanilla ones. We are very familiar. Investment in equity, debentures, mutual funds, debtors, creditors. These are all very simple ones. As long as the instrument is simple, accounting is also very simple. The complexity actually comes when the issuer of the instrument tries to design a complex instrument. When the issuer tries to bring in lots of features, optional and otherwise, that is when the instrument becomes complex and the application of standard also becomes a little difficult. And for right reasons, as all of us know, these standards are all principle based and they are not intended to be prescriptive. So with this little opening remark, greetings to all of you. And as is mentioned at the start, extremely happy to be part of ACA's event. In fact, I'm very impressed about ACA's activities. I wish we had a similar strong body of corporate executives here in Chennai as well. And my respect for ACA went up substantially high the last time I was invited to participate in a program on company law and FEMA, where there was a workshop type Q&A. The quality of questions were amazing. And I want to confess that I had to spend almost 10 days to study, research, to get to reasonable answers on the quality of those practical questions which are there. I'm not sure how much I was able to communicate, but honestly, I learned more preparing for answers to those questions which were there in that particular workshop. So kudos to the entire leadership there and the members who have kept the leadership on their toes, you know. So leadership also is on their toes only when the members keep them on their toes. So the members are so demanding, so intellectual and so knowledgeable that the leaders don't have a choice except to raise the benchmarks on the quality of knowledge dissemination they do. As Mohit said, I'm also personally a strong believer that once concepts are understood in a very simple manner, the compliance with the standards becomes very easy, or anything, any subject for that matter. So my introduction of 109 and 32, the focus will be entirely on making the provisions of the standard as simple as possible And after I finish the presentation, I'll try to leave about 10-15 minutes today and maybe little more time tomorrow, where any questions you might have, we can have a discussion. To the extent I can respond immediately, I will respond. So let me just put across the presentation to you. Vivek, I guess the slide is visible.
Perfect,
Yeah.
sir.
Yeah, fine. So a small customary disclaimer. Whatever I speak now and tomorrow, all of these are my individual, personal, professional views. None of them should be seen as part of the institute of which, or council or the accounting standard board of which I was fortunate to be part of. And on this particular standard, I'll spend a little time on the left-hand side one. On the right-hand side, 3 points. Many of you would have heard me on this, but I'll spend a minute on the left-hand side one. I've come across many who have told that the standard on financial instruments is a little heavy one, and it is because we have borrowed IFRS, implemented IFRS, which is a global standard. I'd like to share with all of you that while it is a global standard in the sense that standard is applied across about 170 countries across the world, other than US, who has a local GAAP, and within US also IFRS is permitted for all the foreign private issuers. So in that sense, it is a global set of standards. What is important to recognize is over a period of time, our institute has been actively participating in the international standard setting process, and almost all of the IFRS which you see and which eventually becomes Ind AS, there has been participation from India. Some of the standards, very active participation, some of it less active participation, but there has been participation from India in the international standards setting. Consequently, these standards, which are IFRS, Ind AS 109 or 32, is nothing but the corresponding IFRS 9 and 32, except for little carve-outs. So as far as these standards are concerned, please do see them as our standards. The moment we participate in the international standard setting process, these standards are our standards. Please don't see them as borrowed from someone else. The moment you feel that you are following somebody else's standard, there is automatically a hurdle which you are setting, which makes it difficult for you to accept these standards. But if you remove that and see that that is ICAI, India, was involved in this standard setting process globally, you will start understanding the standards far different from the way one would otherwise understand. A small introduction of the volume of the standards. The standards is almost about 900 pages. The volume is 900 pages. The standard comprises the basic standard, which is small. The basic standard actually is small, but the application guidance on how the provision should be applied, followed by illustrative examples, and the implementation guidance is what is voluminous. Otherwise, standards per se are not too very big. They're pretty small. But the guidance which comes in the form of visualizing several situations and giving suitable guidance is what makes it a little voluminous. And typically for somebody who is a large bank, the annual report would have disclosures of approximately 50 pages on this, for a very simple reason that in the case of bank, the assets which are there or liabilities which are there are only financial instruments. And when you are explaining it, the disclosures are bound to be voluminous. But if you take a traditional manufacturing company where the financial instruments in books is fairly limited, the disclosures are not as much as one would be scared of. They're pretty simple disclosures. So coverage of the standard. The standard has a huge focus on substance or form. And this is something all of us understand well. And whether it is accounting standards or Ind AS, all of us would like to apply the concept of substance or form. And you'll find this a little more applied. You apply it a little more in the context of financial instruments because the financial instruments are all about contracts where there are rights and obligations which are documented. So the form of the contract should not decide the treatment. It is the substance of it which should decide the accounting treatment. Secondly, the classification of assets. When it comes to financial assets, classically investments which are there, in the context of AS 13, we are all familiar with the classification as current investments and long-term investments. But we are also at the same time familiar about, almost all of us have some experience or exposure to banks. And right from the time the prudential norms came, IRAC norms or the income recognition asset classification norms came, in the case of banks in India, probably for the last 20 years plus, everyone here is familiar that investments are classified into three categories. By the banks, as we are all familiar. So it is almost something similar, which you actually see in the context of 109. So it's not something totally alien to us. So what we see as held to maturity, it is called as amortized cost. What is available for sale, here we call it fair value through other comprehensive income. And what we call as held for trading, here it is like fair value through P&L. So it is something similar. But as far as derivatives are concerned, the value of the derivatives keep changing. So the derivatives gains or losses are to be captured in each financial statement. Sometimes derivatives are specifically identified with a hedged item and the organization chooses to follow hedge accounting. So those cases, how do you ensure matching? There is guidance available here. And there's a concept of accounting mismatches, how to ensure matching. So all of those, there is guidance available in these standards. What is not covered in 109? What is not covered in 109? Tangible assets, intangible assets. For all of which we have separate standards like Ind AS 16, Ind AS 38 and all, inventories, etc. And in standalone financial statements, the investment in shares of subsidiary associates, joint ventures, there is an accounting guidance available in Ind AS 27, Ind AS 27, that is separate financial statements, how to account for the same. Employee benefits, lease obligations. Also, there are financial items, but there are separate standards to cover that. Same is the case with several other items like right to receive reimbursements, share-based payments, etc. Just a quick look at this balance sheet presented in a very conventional T form. So as far as the balance sheet is concerned, it is the financial statement. The income statement is an attachment to balance sheet. Income statement is an attachment to balance sheet because whatever is there in income statement, the final number surplus comes and sits in the reserves and surplus. So income statement is like a schedule to the figure which you have in reserves and surplus. So if you look at the balance sheet now, every item in the balance sheet is covered by some standard or the other, Whether it is fixed assets, property, plant, equipment, intangibles, leased assets, inventory. And if you look at the other items like investments, receivables, loans, cash. And on the liability side, borrowings and payables, they're all covered by the standards on financial instruments. As far as the payables are concerned or provisions are concerned, some of them are covered by specific standards like standard on taxes, Ind AS 12, or standard on provisions, Ind AS 37, or even on employee benefits, liability for employee benefits 19. So in a sense, every item in the balance sheet is now covered by some standard or the other. And by definition, equity, that is equity shareholders funds, capital plus reserves together, is also defined in Ind AS 32 as residual interest in a business. So assets minus liabilities, balance is residual interest. Now, as far as the standard is concerned, it has its principles drawn from what we call as the parent document for the standards, for all standards, which is the Conceptual Framework. So Conceptual Framework is a document which is used by standard setters for the purpose of drafting standards and for the preparers of financial statements, for the auditors of financial statements. They have to use the conceptual framework for two things. One, for developing accounting policies in areas where there is no accounting standard, for example, crypto. Secondly, in selecting an accounting policy wherever there is choice available. For example, we have in this standard itself, trade date versus settlement date. Similarly, if you look at standards like Ind AS 16, property, plant, equipment, subsequent measurement you can follow, either cost model, revaluation model. So which model to choose? The guidance comes from conceptual framework. It is not a blind choice. And lastly, for the users of financial statements, for them to understand how the standards are applied. So the mother document based on which the entire standard is developed is the conceptual framework. So between today and tomorrow, we'll broadly cover these various elements which are listed down in this index, including a recent amendment to Ind AS 109, which is applicable for financial year 21-22. The last one, point number 4, which you see, is an amendment which happened now, applicable for financial year 21-22. So as far as the standards go, we broadly have 3+1, 4 standards which are related to the topic. 3+1, 4 standards which are related to the topic. One is the standard 32, which deals with presentation of financial instruments. Second is the standard 109, which deals with measurement requirements in particular. 107, which deals with disclosures, which another colleague of ours is going to speak to you tomorrow. And +1 is the Ind AS 113 on fair value, where the principles laid down in that standard are relevant to be applied in the standards relating to financial instruments. And as far as financial instruments are concerned, I want all of you to take note of the following. The IFRS 9, which replaced IAS 39, the work started following the global financial crisis of 2008, where some limitations were identified in the erstwhile 39. The standard was developed in a phased manner, and it was supposed to be implemented somewhere in 2013 onwards. But global pressure, eventually, it got implemented globally from 1st January 2018. But we in India, since we were moving from accounting standards to Ind AS, and we did not have the equivalent of IAS 39, we decided to follow IFRS 9 straight away. And we were the first country in the world to have applied IFRS 9 effectively from 1st April 2014. So Ind AS was permitted for voluntary adoption from 15/16. So transition date was 1/4/14. And many Indian companies had chosen voluntarily to move to Ind AS, and they applied this so-called complex standard as early as 1/4/2014, almost 4 years ahead of the rest of the world. So this is a standard where, compared to the rest of the world, there is much more hands-on experience in India. And Vivek was mentioning in his opening remarks the utility value of understanding the standard on financial instruments for several of us. So in this standard 109, it essentially deals with recognition, classification, then measurement, impairment, hedge accounting, derecognition. And Ind AS 32 deals with what constitutes equity, what constitutes debt, offsetting balance sheet items. There's a liability as well as a receivable. So what circumstances we can offset, accounting for buyback of shares, and accounting for or presentation of interest, dividend gains and losses. So let's spend a little bit of time on some of the important definitions. I'll try to keep it as simple as possible. And once we get an understanding of these terminologies and later classification, the accounting, let me share with you, is very, very simple. So first and foremost, what constitutes a financial instrument? Financial instrument is a contract which gives rise to a financial asset in one entity and a liability or equity in another entity. So contract, as all of us know, has two parties. So for one party, it is an asset, and for the other party, it has to either be a liability or an equity. In a picture form, look at these two balance sheets where you have financial instruments, asset side of X Limited, investment in shares is a financial instrument. And for Y Limited, share equity is a financial instrument. Investment in debentures is a financial asset. Debentures issued by Y Limited is a financial liability. Debtors bills receivable is a financial asset. And creditors bills payable are a financial liability. So asset for one and either a liability or equity for the other party. Let's look at the definition of financial liability and then come to financial asset. Somebody would actually love to start with asset and come to liability. The reason why we start with liability is the mirror of what you will see in liability appears in asset and in a little expanded form. That's why we start first with liability. So as far as financial liability is concerned, it broadly has two things. Effectively, 2 plus 2, 4. It has two things with two sub-elements. So effectively, these four things constitute a financial liability. Let's understand this whole definition with very simple examples. Please do not get entangled with some of the terminologies or jargons which are there. So what is a financial liability? Part one. It is a contractual obligation to either deliver cash or another financial asset. So it's a contractual liability. Think of bills payable. I can either settle it in cash, or if I have a bills receivable, I can endorse that bills receivable and settle this liability. So contractual obligation, I can either settle it in cash or by giving another financial asset. Second sub-element, exchange financial instruments with another entity under conditions that are potentially unfavorable. All of us are familiar with options contract, where you have the holder of the option and the writer of the option. Holder of the option, the writer of the option. So as far as the writer of the option is concerned, the writer is undertaking an obligation. And the holder of an option is holding a right. And that person will exercise the right if it is favorable to him. So if it is favorable to holder, as a corollary, it should be unfavorable to me. For example, I write an option in favor of, let's say, Mr. Agarwal, saying that 1 month from now, I am ready to sell 1,000 shares of Infosys at a price of, let's say, 5,000 per share. If the market price of the share is 4,500, Mr. Agarwal will not exercise the option. But if the market price is 5,500, he will exercise the option because it is favorable to him. He will get the shares from me at 5,000, whereas market price is 5,500. And as a writer of an option, for me, it is unfavorable because I have to deliver something at 5,000, which in the market is 5,500. So a contractual obligation where I am required to give something on terms which are potentially unfavorable is a liability. So this is part 1 of the definition of financial liability. Part 2 is, and please note, part 2 does not come every day in life for everybody. This comes little rare. It comes little rare only when there are some capital transactions, some private equity transactions, those kind of cases it comes. So second is a contract that will or may be settled in entity's own equity instrument, which is a non-derivative, for which entity is obliged to deliver a variable number of entity's own equity shares, or a derivative which will be settled other than by exchange of a fixed amount of cash or another financial asset for a fixed number of entities' own equity instruments. Let me give you an example for each of this. Look at the right side of the chart. Look at the right side of the chart. And the first element, a non-derivative to deliver a variable number of equity shares. So there can be transactions where X Limited, take a sum of 10 crores from you. I take a sum of 10 crores from you and I tell you that this 10 crores of amount I will convert into shares 2 years later based on market price on that date or based on EBITDA multiple, EBITDA of that date or earnings of the date, something. So amount is 10 crores. I have already got it, fixed amount. But the number of shares which I will give you is variable based on market price on the date or some formula on the date. That is again a liability where as a company, I have an obligation to settle by giving those variable number of shares. Second situation, second element, a derivative where you have to settle it other than by a fixed amount for a fixed number of own instruments, So second is a case where I am X Limited. I have agreed to make available to you some 1 million shares, some 10 lakh shares to be applied by you at a price which will be determined 2 years later. So the amount which I will get is an uncertain amount. So I have obligation to allot shares, but how much is the amount is uncertain. So these type of contracts to settle in own shares are also treated as a liability, What situation it will be treated as equity? Let me explain here itself, while it will come later as well. We have this very famous expression called fixed for fixed. If the contract is that for a fixed amount of money, a fixed number of shares will be given at later date, that kind of an instrument will be treated as equity. So if the amount is fixed and the quantity of shares is fixed, if both are fixed, then it is treated as an equity instrument. But if any of them are variable, then it is treated as a liability. Even though it will be settled in the form of shares, it will be still treated as a liability because from an organization point of view, there is uncertainty on either the number of shares or there is uncertainty on the amount. So those transactions are all accounted as liability in the balance sheet. So what you see in the right side of the chart is what you will come across in almost all private equity transactions. And this is where the difficulty arises. On the face of it, it looks like somebody already paid me 10 crores. I have to give so many shares. I need not repay cash. I need not repay cash. So logically, why don't I treat it as equity? That's the argument which will come. So those situations, the solution is very simple. Since there is uncertainty for the amount for the company in terms of number of shares, or if number of shares is known, price will be determined later and amount is uncertain, those will be treated only as liability. It is like somebody is giving you cash in advance for shares to be issued at a later date. So consequently, it will be treated only as liability. If you want to treat as equity, the rule is, keep it very strong in mind, fixed for fixed. For a fixed amount of cash, a fixed number of shares, no uncertainty whatsoever, it is treated as equity. Otherwise, it will be treated only as liability. Now, coming to the definition of financial asset. Unlike financial liability, which had two parts, here there are four. Financial asset comprises cash. Cash is treated as financial asset. Second is contractual right. Mirror image of what we saw earlier. Contractual right to either receive cash, think of bills receivable, or another financial asset from another entity. Think of debtors. Debtors can be replaced by a bill of exchange. So it can either be, debtors can either be settled in cash or by getting another financial instrument, a bill of exchange. So that is sub-element A. Or exchange financial instruments with another entity under conditions that are potentially favorable. Recall, we discussed about writer of an option, holder of an option. So as far as holder of an option is concerned, recall the example I gave you. 1,000 shares, 5,000 exercise price. So if the market price is 5,500, then I will exercise the option because it is favorable to me. I'm getting something at 5,000 for what the market price is 5,500. So on conditions which are potentially favorable. The third element of the definition of financial asset is equity instrument of another entity. So investment in shares, equity shares of another entity is also a financial asset. Recall the first definition of financial instrument. Financial instrument is asset for one and an equity for another or liability. So asset for me, equity for another. It is a financial asset. Fourth element of the definition, a contract that will or may be settled in entity's own equity instrument and is a non-derivative for which entity may be obliged to receive a variable number of entities' own equity instruments. So let me give an example for these two elements. In Indian context, a company is prohibited from acquiring its own shares except for the purpose of buyback and cancelling. Otherwise, we are prohibited. But for buyback, you are permitted to buy. Now, so let's assume I am a company who now engages with a member of stock exchange, a broker, saying that here is 10 crore rupees, buy shares for this amount to me, buy my own company shares. So for 10 crores, he would buy at whatever prices and I would receive a variable number of shares. So that is a financial asset. Second situation, I tell the broker please go and buy 10 lakh shares in the market within this price range. He goes and buys that. So it's a contract where he goes and buys 10 lakh shares at different prices. So for a number of shares, the amount is not fixed, not a fixed amount of cash. He would buy at whatever different prices. So these kind of contracts are all called as financial assets. So financial assets are cash, then think of debtors, then think of option holder of an option, then think of situation where I give money to somebody and tell buy whatever number of shares for this amount. So you get variable number of shares. Last situation where I tell him buy so many shares at whatever price and the amount is variable. And then investment in equity. All of these are called financial assets. So these are some illustrations which are available, all of which you can go through later. Now, definition of equity. This is a important one. Equity is residual interest in the assets of an entity after deducting all liabilities. Equity, in simple words for all of us, is shareholders' funds. Capital and reserves together is the residual interest. Examples of equity. One is what is called non-puttable ordinary shares. The terminology looks very heavy, but in simple terms, very simple terms, the equity shares you and I apply in IPOs and all, public issues and all, those equity shares are all your non-puttable ordinary shares. Non-puttable means I have applied for those shares, shares got allotted. I cannot go back to the company. For example, I have applied for shares of Paytm 3 months back. Now I cannot go back to Paytm and tell, no, please give me back my money. I can't put it back to them. So they are called non-puttable ordinary shares, which are nothing but, in very simple terms, forget the jargon non-puttable, it can put you off. It is nothing but, in very simple terms, equity shares, as you and I know. Second is puttable instruments. If they are not financial liabilities and they meet certain conditions. I'll explain this in the next slide. But at this point, think of your investments in mutual fund. All of us invest in mutual fund. So our investments in mutual fund is the corpus of the mutual fund. And in the mutual fund, we are aware that we can go and give back our units and get back the money. We can give back the units and get the money. So you can put it back. So your investment in mutual fund is a puttable instrument subject to certain conditions that will also be treated as an equity instrument. Third is instrument with an obligation to, and similar to puttable instruments, conditions are there, wherein the holder of the instrument will get money only on liquidation and he will get only proportionate to the net assets available. So those kind of instruments where the holder of instrument will get money only on liquidation and whatever net assets are available, that is also treated as an equity instrument. Irredeemable preference shares. Of course, Indian context, it is not there, but it is important to have it in the standard because you may have some overseas subsidiaries and those countries, your subsidiary might have issued it. And when you prepare consolidated balance sheet, that irredeemable preference share will come and sit. If you have issued it to outside shareholders, outside people will come and sit in your balance sheet. That is also a equity. Warrants or call options, for purchase of non-puttable ordinary shares. All of these are called equity. So what is pending is puttable instruments. Puttable instruments, please note, if you can have the right to go and put it back and the issuer is forced to return it back to you, it is a liability. But if certain conditions are fulfilled, then it is treated as equity. So what are those conditions? Those conditions are broadly two categories. One is instrument related conditions, other is issuer specific conditions. So instrument specific conditions, for example, is that the holder will be eligible only pro rata net assets on liquidation. So I can't go and surrender it any day, but whenever the fund is closed, whatever net assets are available, I'll be eligible to get proportionate net assets. And this particular units are subordinate to every other instrument. So any other instruments are there, they will all be paid. And finally, whatever is left should be payable to this. And these are all instruments where they should all have identical features and all. There are some issuer specific conditions that they should not have any other financial instrument where there's an obligation to pay them based on the profits, cash flows, or changes in fair value of net assets. So if you are obligation to pay somebody else, then this instrument will be not be treated as equity. This will also become a liability. So treat it as an equity instrument. It is extremely important that there should be a free waterfall of net assets which will belong to the unit holders. Then it will be treated as equity. Then definition of financial guarantee. This definition comes in 107, but it's relevant here for the reason that when you give a guarantee, I've given guarantee to subsidiaries, group companies and all. Every balance sheet date, you have to assess whether there is a possibility of the guarantee getting invoked. And if the guarantee is likely to get invoked, you have to make a provision for that liability. From that sense, guarantees are important. They are part of the standards on financial instruments. Guarantee, all of us know, it's basically a contract where you agree to compensate the other person. Now, almost the last of the definitions on derivatives. Derivatives are instruments which have three characteristics. One, the value of the derivative changes with the underlying. Underlying can be interest rate risk, currency risk, commodity risk, whatever. So that is one. Second condition, all three conditions need to be fulfilled. Second condition is there is either no investment, for example, forward contracts, or a very small investment like option contracts, option premium. It's a very small amount which you pay. So there is either no consideration, no initial investment, or a very small initial investment which is there. And lastly, these are contracts settled at later date. So if all the three conditions, important, all the three conditions are fulfilled, then it is treated as a derivative. Now, as far as the standard goes, the core of the standard is to classify the financial instruments either as a financial asset, financial liability, or equity based on substance of the instrument and not on the form. Now, so definitions, these slides are a repeat of what I presented to you in a chart form, except that they borrow exactly the same language as what is there in the standard. Now, this slide, please follow a little carefully. this slide deals with what are called commodity contracts. We are all familiar, commodity exchange is also a very active exchange. And there are many participants in the commodity exchange. Now, as far as commodity contracts are concerned, contract or futures or options relating to commodity contracts are on the face of it, outside the scope of the standard on financial instruments. However, in practice, there are many cases where there are people who understand the commodity market so well that they keep buying and selling futures and options in the commodity contracts and settle them on a net basis. So when they buy 1,000 tons of copper, 1,000 tons of steel, they don't take delivery, but based on the price difference on the date of the contract expiry, the difference is settled in cash. So what the standard provides is, if commodity contracts are not for taking delivery, if commodity contracts are entered not for the purpose of own use of material, and if the commodity contracts are entered essentially for settling on a net basis, such situations are covered within IFRS 9. So in terms of a flow chart, it reads as follows. For clarity, I'll read it verbatim. Whether the contract can be settled net in cash. If the answer is no, you cannot settle net in cash, and it has to be only by delivery, then the question of Ind AS 109 does not arise. If it is capable of getting settled in cash, if it is capable of getting settled in net in cash, you have to see whether my intent is to take delivery or to settle net in cash. What is my intent? If my intent is not to take delivery, then I will treat it as a financial instrument. But if my intent is to take delivery and I'm exercising the option of fair valuing these contracts, then again I would apply 109. Otherwise, it will be outside the scope of 109. So commodity contracts will come within 109 in situations where somebody is not taking delivery for own usage, or has not exercised the fair value option. Now comes the next section on 109, which is recognition. So as far as recognition is concerned, what it means is recognizing the asset or liability in the financial statements is what recognition deals with. But what is important to recognize is, or note is, there are few situations where you actually don't recognize asset or liability in books, but you have to still capture the fair value changes. For example, firm commitment to purchase goods or services at a later date. Forward contracts. So when you enter into a forward contract, there is no consideration also. But forward contract, there would be fair value changes. In a firm commitment, let's say a commitment to export or import, the currency movements which are there. So those value losses you will recognize in the financial statements. So while the item per se will not come in financial statement, the value changes will come in the financial statements. When do we recognize? Very simple thumb rule, very simple thumb rule. when to recognize. You recognize when you become a party to the contract. So whenever you become a party to contract, you recognize financial liability, you recognize equity. But as far as financial assets are concerned, where the financial assets are subject to a regular purchase or sale, you keep buying, selling, those cases alone, the standard gives a choice of what is called trade date or a settlement date. So normally, you have to account it when you become party to the contract. One exception is in the case of financial assets, which are quoted in a stock exchange, regularly traded, bought, sold. So those kind of contracts, you have a choice of either following a trade date accounting or a settlement date accounting. All of us are familiar that when you're transacting with some instruments on the stock exchange, the settlement is T+1, T+3. So I've contracted to buy today, but the settlement happens tomorrow or 3 days from now. So there's a trade date, the date on which I have transacted, and there's a settlement date, T+1, T+3, whatever is the date. So for such financial assets alone, and please note, trade date versus settlement date accounting choice is available only for financial assets, and that too only for financial assets which are regularly traded on an exchange. For them alone, you have a choice of trade date versus settlement date. All other cases, financial liability, equity, all other cases of financial assets, accounting should happen the moment your contract is done. The moment you become a party to contract, you should recognize it. Now, this is an important difference you should keep note of. So trade date versus settlement date. Think of a T+3 transaction, T+3 stock exchange. Transaction takes place on 30th of March, but the settlement happens on 2nd April. Settlement happens on 2nd April. So in trade date accounting, you will recognize the transaction on 30th March and 31st March balance sheet date. Any gains or losses, mark to market, also you will recognize. But if you follow settlement date accounting, even though you became party to contract on 30th March, you will recognize the transaction in your books only on 2nd April. Only on 2nd April. However, since you are crossing 31st March, since you're crossing balance sheet date, reporting date, the standard says that, look, the mark to market difference between 30th March price and 31st March price, that gain or loss, you have to recognize in financial statement because that gain or loss belongs to you. So you became party to contract on 30th March. You may recognize the asset in books on 2nd April, but on 31st March, there is a gain or loss, and that gain or loss should be recognized in financial statements, and very logical too. Next, we come to derecognition. What we saw now is recognition. We are now coming to derecognition. Derecognition is when do I remove it from my books? So we have separate principles for derecognition of financial asset and derecognition of financial liability. As far as derecognition of financial asset is concerned, you can derecognize only when the contractual rights to receive cash flows have expired. Like, for example, I have invested in bonds. The bonds got repaid and there's nothing else you are eligible. So there are no further rights available. So those cases, you de-recognize the asset. Similarly, debtors, 5 lakhs. The other guy has paid you off. Having paid off, there's nothing else you can get from him. So remove the debtors off. So contractual rights, my rights to receive have over. Or when there's a transfer and the transfer qualifies for derecognition. Watch these words carefully. There's a transfer of debtors. There's a transfer of bills receivable. There's a transfer of bonds. And it is qualifying for derecognition, which means I've sold off my debtors. I've sold off my bills receivable. I've sold off the investment in debentures, bonds. I can derecognize not when I sell, but if it is qualifying for derecognition. What is this qualifying for derecognition mean? Qualify for derecognition means substantially all the risk and rewards I should have transferred to other party, and I should not have retained any control on the asset. For example, take a case of bills receivable. If I have negotiated the bill receivable, I have endorsed the bills receivable with recourse. What it means is the risk of default is still with me. So even though I have transferred each case, you will write as a liability. After due date, if this bill has no collection obligation, then you can square it off. Second situation is there is a portfolio of receivables which I'm securitizing to other party. And that portfolio of receivables, if I am going to control the collection process, so I have agreed that I will collect money and keep paying to you. So I am retaining control. So those cases, again, it will not qualify for derecognition. So if you have to qualify for derecognition, I have transferred and qualify for derecognition. Important is substantially all risk and reward should have got transferred, or I should not have retained any control on the asset whatsoever. Only then it will qualify for derecognition. Now, in the form of a flow chart, it is precisely the same which I have told you, I decided to retain as much content as possible so that when the slide deck is shared with you, it's easier to understand. And I would encourage you to use this deck for your internal staff training purposes so that there is much more dissemination of this knowledge. Now, derecognition of financial liability. So financial liability, think of creditors, bills payable, debenture liability. So I should derecognize a financial liability when it is extinguished. So like fire is extinguished, liability is extinguished. When is the liability extinguished? Liability gets extinguished in one of the three forms. It is discharged. I paid off my creditors, liability is extinguished. Or it is cancelled. Liability will get cancelled where the other party has, let us say, waived, or I have transferred a financial asset. I gave a bill receivable and cancelled it. So those cases also it extinguishes. Or expires. So there is a due date, and for that particular due date, there is no claim. So let's say a limitation law, there's no claim and the other party cannot claim. So there again, you de-recognize the liability. So de-recognition of liability, 3 situations. On de-recognition, you have whatever gains or losses, if any, you should recognize in income statement. I'll give you a small example of why gains and losses will come. Why gains and losses will come. Let's take a small situation where I have a bills payable. If I am settling it with a bill receivable, the credit risk of both may not be the same. So in that process, there might be a gain or loss which will come. Similarly, there can be instances where I am replacing my existing debentures with a new set of debentures. So old debentures go off and new debentures come in. So there again, the terms are different. So de-recognize the old and recognize the new one. So in the process, gains or loss gets recognized. Now, classification and measurement principles. This is an important part of the standard. So after this, we move on to subsequent measurement, impairment. Maybe I'll park there and tomorrow I'll do hedge accounting. Now, as far as classification is concerned, I want all of you to have this clarity that the classification is done not at the time of purchase, but the classification is relevant for what we call as the subsequent measurement. So classification becomes important essentially for subsequent measurement. Recall AS 13. When I buy investments comes in. But whether you value at cost or market fair value, all of that is that classification of current or long term is for subsequent measurement. Same funda here also. But that classification is important for the measurement principles. Depending on what is the classification, the measurement guidance is given, both initial measurement and subsequent measurement. So as far as financial assets are concerned, they are classified into 3 categories. And as far as financial liabilities are concerned, they come under 2 categories. So financial assets are 3 categories. Financial liabilities are 2 categories. Now, for those categories, recall I told you IRAC norms, prudential norms of RBI and all. The 3 categories in Ind AS are referred to as amortized cost, fair value through OCI, fair value through P&L. So they are coming under 3 categories. I just saw someone raise the hand. What I would recommend is please make a note of a query. The last 15 minutes or so, I'll try to leave today. So I'll take all those questions and address it. So let me put in one flow. So you have 3 categories of assets and 2 classifications as far as liabilities are concerned. And as I told you, this classification is very important for the initial measurement and for the subsequent measurement. It is from that perspective that the classification is important. From ease of understanding, think of AS 13, think of investments, where you classify current investments valued at lower of cost and fair value, long-term investments valued at cost. Exactly similarly here, the measurement guidance is different for each of the 3 categories, and we'll discuss this in detail as we go. So financial assets, they can either be a debt instrument, investment in debentures, investment in bonds, receivables, or it can be investment in equity, or it can be a derivative. So these financial assets are classified under one of these three categories. And please note, this classification is not a choice, You need to go through a structured process and decide whether it is an amortized cost category or a fair value through OCA category or a fair value through P&L category. So there's a very structured approach of arriving at which category the financial asset will fall in. And some options are also available, which you have to elect initially. So there's an irrevocable option you can exercise initially for classification as well. I'll walk you through those a few minutes from now. Now, what are the criteria for this classification? There are two important tests, and keep them in your mind. Two important tests. One is called contracted cash flow test. Other is called business model test. So contracted cash flow test is a test of whether the instrument gives you specified payments of principal and interest. So from the contract, financial asset is a contract. If that contract gives you rights for specified principal and interest, then it is satisfying the criteria of contracted cash flow test. If there are no specified payments, either for principal or interest or both, then it fails the test of contracted cash flow test. Debt instruments, debtors, receivables will pass the contracted cash flow test. So bonds, investment in bonds, investment in debentures, you are eligible for a specified payment of principal and interest, SPPI. Whereas investment in equity instruments, there's no guarantee of, there's no contract which tells you will get this amount or this amount of return. You don't get it. So contractual cash flow test, which means if you are eligible for specified payments of principal and interest, typically it is a debt instrument, investment in debentures, bonds, receivables. These are all what follow that particular test. Else, they become equity. Second, once you pass the contractual cash flow test, yes, there is a specified payment of principal and interest. One small important point. When we say specified payment of principal and interest, it means interest which can be a fixed amount or interest calculated on a particular formula. For example, there can be investment in bonds, 6% interest rate, frozen. Or there can be investment in bonds which can tell SBI PLR plus 1%. That is also treated as contractual cash flow satisfied because there is a specified amount of interest you will get. It is specified that you will get SBI PLR plus 1%. So variable instruments also fulfill the test of contractual cash flow test. Then we have what is called business model test. Business model test is, am I acquiring this asset with an intent of holding till maturity, or have I acquired this asset with the intention of holding it, and whenever opportunity comes, I will sell it off also. I don't have intention to hold it till last date. 10-year government bonds, 10-year debentures. So business model test, do I want to hold it for the full 10-year period or hold it as long as possible. Whenever prices are good, I want to sell and make money. So business models are of two types. One, hold till maturity. That is hold to collect fully. Second is hold to collect or sell. I'll hold it either for collecting or selling, either way. That is called business model test. So we have to go through these two tests for determining whether the financial asset will be classified as asset which is valued at amortized cost or fair value through OCA or fair value through P&L. The flow chart is as follows. Very, very, very simple test. This is a very simple test and they are almost like the back of the palm. Contractual cash flow test. If the instrument gives you specified payment for principal and interest, then it is fulfilling the contractual cash flow test. If the instrument does not specify the payments of principal and interest, how much will come, when it will come, you don't know. Those cases, those instruments will be valued only at fair value through P&L. Fair value through P&L, like your perpetual bonds, So they'll be valued only at fair value through P&L. So whereas those instruments where there's a very clear specified payments of principal and interest, typically bonds, debentures, you have to now test it for business model. Business model, look at the three things. One is I want to hold till maturity. Then you value it at amortized cost. Second is I will hold it, but if the opportunity comes, I will sell it off. Then you value it at fair value through OCI. Last is neither first scenario or second scenario, and I have chosen to value at fair value. So if I have chosen to value at fair value, then I will value it at FVTPL category. So for all your financial assets, you have to go through this test of contractual cash flow test, followed by business model test. For simplicity, if there are no, I'll take you through a Q&A mode. You figure out the answers in your mind before I tell the answer. I'll give you 5 seconds for that. So does the financial asset, that is bonds, debentures, instrument, whatever you have put, does that instrument have contractual cash flows for principal and interest? If the answer is no, classic example is equity instruments, perpetual instruments. You have to value only at FVTPL. I'm pausing so that you can answer in your mind ahead of me answering. If it fulfills the contractual cash flow test, there is specified payment of principal and interest. Then you have to do what is called business model test. Business model 1, I want to hold it till the last date. Then you value it at amortized cost. Fair value, you can forget. Second business model, I will hold it, but whenever a good opportunity, a price comes, I may sell it off. Those cases, it will be treated as fair value through OCI. Neither of this or a voluntarily chosen, then it will be FVTPL category. So all financial assets will fall under one of these three classifications. These three classifications for the purpose of valuation. Now, for equity instruments, we have the following. the contractual cash flow test is not applicable because in equity instruments, there is no specified payment of principal, all that stuff. So question is, are you holding it for trading? Then automatically it is fair value through P&L. If it is not held for trading, so I bought shares of Paytm, bought shares of Zomato, I bought shares of whatever, carry it at fair value through OCI. I have to choose. A choice is available so that market price movements need not affect my P&L. I can take it to FET OCI. If I don't make any choice and I remain silent, then it becomes an FETPL category. Derivatives. So financial assets are three categories. Recall financial assets are three categories. They're either debt, equity, or derivative. This is for debt, the equity, and now derivatives. As far as derivatives are concerned, holder of the option, derivatives. Derivatives should always be valued at FETPL. FETPL, except in cases where the derivatives are taken for the purpose of hedging and you are decided to apply hedge accounting. Please note, hedge accounting is not mandatory, it is optional. So if I have taken a derivative and I have decided to follow hedge accounting, for which I have to follow some stringent conditions, I'll walk you through tomorrow. So those cases, you have to value it at FETPL. So all derivatives as FETPL except those which you have taken it for the purpose of hedging. Financial liabilities, very simple, only two-tier classification. Fair value through P&L or amortized cost. So as far as liabilities are concerned, depending on the behavioral aspect of how you're dealing with liability, it will be treated as fair value through P&L. Otherwise, it will be treated as amortized cost. Amortized cost is more or less like a residual category. Now, when does someone get identified as fair value through P&L? When is an instrument identified as fair value through P&L? It gets identified as fair value through P&L in either of the following conditions. One, it is held for trading. Trading means buying, selling, buying, selling. So if that is the intent and that is you are working on, you are buying, selling regularly, then the effect of your operations, the performance of your operations should get reflected in your statement of performance. The statement of performance is nothing but P&L. So where you're operating, buying, selling on a regular basis, those cases, it will automatically be treated as FETPL category, whether liability or asset. Second situation, I could have treated it as amortized cost. I could have treated it as FET OCI, but I choose to treat it as FETPL. Then it also becomes FETPL category. Now, as far as the held for trading is concerned, how do you determine whether the instrument is held for trading? So three instances. In these three instances, it will be concluded that the instrument is actually held for trading. Instance number one, all of these are commonsensical. Even if the standard were not there, you would have done the same. Instance number one, I have acquired it and disposed it. I have acquired it and disposed it in the near term, short term, or there is either evidence of behavior like that or that is my intent. then it is treated as held for trading. Instance number 2. Please recall the words I'm using. These are 3 instances where, because of your behavioral aspect, it will automatically be treated as held for trading and consequently FVTPL. Behavioral aspect 1, buy, sell, buy, sell. I bought with the intention of selling. I bought and sold in near term. That is held for trading, FVTPL. Second, these instruments are part of a portfolio which I'm managing together. So there are 5, 6, 10, 20, 30 instruments. I'm managing all of that together. I'm not looking at profit and individually. I'm looking as a group, as a whole. I'm managing it so that overall I should make a profit. So the moment your behavior is towards managing a portfolio, those cases, again, it will be treated as held for trading and consequently FVTPL. Third, a derivative which is not designated as a hedging instrument, those derivatives. So for example, many of us trade in futures of shares, options of shares. There's nothing we are trying to hedge, but we just want to get the benefit of that market price movement. So those derivatives will all be treated as held for trading and consequently FVTPL category. So now, in the form of a flow chart, this is in the form of a flow chart. I have explained this earlier. Recall I told you, for financial assets, the starting point is cash flow feature test, contractual cash flow feature test. If there are no contracted cash flows, look at the red one, FVTPL. Doesn't mean danger. It says FVTPL as a category. If it fulfills contractual cash flow test, specified payments of principal and interest, then you apply the business model test. And if the business model test, if it is held for collecting contractual cash flows, and the answer is no, then FVTPL. If the answer is held for collecting contractual cash flows as well as for sale, and the fair value option is used by the entity, then it is fair value through OCI, else it becomes amortized cost. And for equity instruments, you have a choice at initial stage to either treat it as FET OCI or FETPL, but that is an irrevocable option, And that option, you have to exercise it very, very carefully. I'll tell you why you should exercise carefully. It will always tempt to treat equity instrument as fair value through OCI because fair value changes will go into OCI and not P&L. But please note, in fair value through OCI category, tomorrow when you actually sell, the gain or loss cannot be brought to P&L. You can at best transfer it only to retained earnings. So it should be very clear. If you have any intention that I want that profit to come into my P&L and use it for whatever purposes, then you should choose to keep it as FVTPL. But you want to avoid volatility of price movements and all, and keep it in fair value through OCI. So which means you are not keeping it as part of your operating performance, then gain on sale or loss on sale will not come to P&L. It will remain in OCI, or you can transfer it to retained earnings later. Now, so these are examples of what we have discussed, So let me move forward to reclassification. As far as the financial assets are concerned, The standard allows the reclassification to be done. Of course, there are conditions around this. There can be reclassification from, let's say, fair value through P&L to fair value to OCI, in which case, whatever fair value you're already appearing in FVTPL category will become fair value to OCI. It will continue at that fair value. And the gains or losses which you already recognize in P&L, you will allow it to peacefully remain in the P&L. Second is fair value through P&L to amortized cost. So those cases, when you're shifting it to amortized cost, you have to measure it at fair value. And once it comes to amortized cost, thereafter start measuring at your effective interest rate. So like this, for each of the categories, when you migrate, there are rules relating to what is the rate at which you migrate and how the subsequent accounting needs to be done. And these are illustrations available on the accounting entries for the same. Now comes the amortized cost measurement. As far as amortized cost is concerned, the amortized cost is nothing but the accounting which is done by applying the effective interest rate for the stream of cash flows which you are eligible. These terminologies look a little sophisticated, but let me tell you, they are as simple as what we do in lease accounting AS 19. They're as simple as that. I'll try to give a very, very simple example. Let's assume I bought bonds of face value 100, carrying interest at 6% at a price of 102. So my cost is 102, brokerage is 1 rupee, so total 103. Assuming it is FAT OCI 103 or amortized cost category 103. This 103, I will get 6% interest annually, and at end of life, I'll get back 100 rupees. At end of life, I'll get 100 rupees. So I paid 103, I'll get interest 666, and I'll get back 100. So in this case, that extra 3 rupee cost should also get written off during the life of the instrument. You calculate what is an effective return, nothing but in simple words, IRR. So initial outflow 103, inflow 6666 and 100. So your effective rate which you get could be, let us say 5.8. So you will start measuring interest income applying 5.8% on 103. Then you'll receive 6 rupees on 100. Then again 5.8% 103. Then you'll get back 6 rupees. And finally you'll get back 100 and that account will get closed. So that kind of an accounting is called amortized cost. Now, measurement principles. Having understood the 3 categories, FVTPL, FVT OCI, and amortized cost, what is the measurement principles? For measurement principles, there is what is called initial measurement and subsequent measurement every balance sheet date, every reporting date. FVTPL category, initially recognized at fair value and every balance sheet date also at fair value. So gains or losses in the market price will also go to P&L. Next, we have amortized cost. In the case of amortized cost, if it is a financial asset, the example I gave you, 102 rupees plus transaction cost, 103. If it is liability side, I issued debentures 100 crores, expenses of issue 10 crores. So I get only 990 crores. So I'll recognize at fair value adjusted for transaction cost, plus or minus. So amortized cost, financial assets and financial liabilities. Every balance sheet date, I will measure it at amortized cost, which is nothing but, in our example, which I gave you, 103 plus 5.8 minus 6 amortized cost. Next year again, plus 5.8 on the balance amount minus 6 amortized cost. You keep calculating it. And in this method, no fair valuation. The interest income, the example I gave, 5.8% on 103, that income will go to your P&L. Then fair value through OCI. In fair value through OCI category, initial accounting is at fair value plus transaction cost. And please recall, fair value through OCI is available only for financial asset, not there for financial liability. It's only for financial asset. Every balance sheet date fair value, interest income will go to P&L. Gains or losses will go to other comprehensive income. And if it is a debt instrument, so if it is a debt instrument, the gains or losses on FET OCI category will be recycled to P&L. But if it is an equity instrument, fair value through OCI, dividend income will go to P&L, but gains or losses on sale will remain in OCI. You can at best transfer it to retained earnings. The logic is debt instruments, the gain or loss is essentially nothing but interest rate adjustment, and hence it goes to interest, like interest to P&L. Whereas in equity instruments, the gains or losses are beyond dividend. They are relating to the valuation of the entity you have invested. So those gains or losses, you cannot recycle it because they are not reflecting the operating performance of the instrument you are dealing with. It will remain in FET OCI. At best, you can transfer retained earnings. So these are effective co-interest and all. We have discussed this. The numerical examples available, which you can understand on your own later. Now, important slide here again. Recall we discussed just a few minutes back. Initial recognition, whether it is FETPL category or amortized category or FET OCI category, initial recognition is always at fair value. And for FETPL and FET OCI category, subsequent recognition is also at fair value. So how do we determine fair value? So as far as fair value is concerned, the fair value determination is guidance is available in Ind AS 113, which prescribes a three-level architecture, three-tier architecture. So three-tier architecture called level 1, level 2, and level 3. Level 1, fair value determination is based on market price. Always market is king. Market is made up of large numbers of buyers and sellers. So they know the best. So whatever market price, that is the fair value. So fair value is determined. There's a definition in 113 as your exit price. If I sell, what will I get? So level 1 hierarchy is market price. Level 2. Some cases, the shares are thinly traded, hardly any transaction. If you look at the 8,000 companies listed on stock exchange, almost 7,000 companies, there is no trading. Almost 7,000, there is hardly any trading. So those cases, they're illiquid. They're illiquid. So those cases, you should look at whatever is the observable market price and make suitable adjustments. So observable market price, there can be one isolated transaction. You can't take that as the market price. So you have to adjust it suitably. That's called level 2. Then there is what we call level 3. So there is no market price available at all. So unlisted instruments and all, no market price available. Those cases have to follow a valuation approach. So there are income approaches, market approaches, there are different approaches. So follow any of those approaches and arrive at a valuation. So fair valuation determination, please note, most of us, for our trading stock, it is generally only listed entities. So fair value determination is not difficult. And fair value through OCI, sometimes you could have unlisted entities and all. So those cases, you have to go through a valuation model. Now, so the level 1, level 2, level 3, which I mentioned to you. Now, we come to embedded derivatives, and probably I'll close here. Tomorrow, I'll take up impairment and hedge accounting. Impairment and hedge accounting. Impairment, I put a very simple numerical illustration. Particularly trade receivables, impairment, how do we calculate? I'll walk you through that tomorrow. So for today, I'll conclude after this derivatives introduction. Hedge accounting also will take up tomorrow. So derivatives can either be a financial asset or financial liability. Please recall, I discussed earlier, I can be a writer of an option or a holder of an option. I can be either. So derivative can either be a financial asset or financial liability. And derivatives, both initial and subsequent measurement will be only at fair value. And these instruments by default will be an FVTPL category unless this derivative is used as a hedging instrument for hedging a particular risk and you are applying hedge accounting. Please note the word and you are applying hedge accounting. So if I have taken derivatives for hedging, automatically hedge accounting will not apply. Hedge accounting is a choice you have to make, fulfill some documentation and other conditions, then only you can apply hedge accounting. Why someone will choose hedge accounting is because you can do a matching of your volatility of your hedged item and the hedging instrument. They can come in the same period so that your P&L is not affected by the volatility. So those cases, if you decide to apply hedge accounting and you fulfill those conditions, you can do. Otherwise, derivatives by definition, as default, they're all treated only as a FVTPL category. Then there are what we call as embedded derivatives. There are many cases where the derivative is sitting inside an existing contract. For example, I have subscribed to debentures of a company which also gives me an option, a sweetener, to apply for 1,000 shares at a later date. I apply for debentures of 10 lakhs and an option to apply for 1,000 shares at a later date, 3 years from now. So those cases, the debenture contract includes an option to apply for debentures at a later date. So those kind of contracts are called embedded derivatives. The derivative is sitting inside the host contract. So examples of those, So these kind of embedded derivatives, you have to split it up. You have to split it up and then do the accounting. So let me give some examples. Let me give you some examples. So as far as embedded derivatives are concerned, there can be instances where within a group of companies, and these are pretty common, they're pretty common, particularly with all this private equity transactions happening, pretty common, where you apply for debentures of subsidiary A, you're also eligible to get shares of subsidiary B 3 years from now. Those cases, it is not embedded derivative. They'll be treated as two separate instruments. Similarly, for the same company, I'll have one contract for debentures, another contract for option to subscribe for shares at later date. So these are two separate contracts. They will not be treated as embedded derivatives. They are treated as two separate instruments and accounting will follow. Now, in the first example which I gave you, where it's a contract relating to subscription of debentures, and inside the same contract, it gives an option to apply for shares at a later date. So what the standard provides in terms of accounting is 3 criteria to be evaluated. Are the economic characteristics very closely related? Could I have issued another instrument? And lastly, have I chosen not to value the combined instrument at FATPL? So if all the 3 conditions are fulfilled, those cases, I have to segregate the instrument. I should segregate the instrument, account for debenture separately and the option separately. So if all the 3 conditions are fulfilled, I have to separate the instrument and account for the same separately. So in this example, the investment in debentures, I'll treat it as a debt instrument, maybe amortized cost, and the option to subscribe for shares at later date is a derivative FATPL category. I'll value it separately. So embedded derivatives, you do that particular split, So this is the flow chart of that split to be done, Then we have this compound instruments. I'll complete another 3-4 slides and then stop. Compound financial instruments. Simple example of compound instrument is a convertible instrument. So let's assume I apply for debentures of a company, 10 lakh rupees. Market interest rate is 6%. The coupon rate is also 6. But I apply for debentures of a company where it gets converted into equity shares after 5 years. So those cases, the coupon rate is 4%. So here is a case where there's an interest payment liability and there's an equity element also. So the interest rate is actually 6, but somebody is giving you at 4 because of the equity kicker. Such instruments are called compound instruments. So in those instruments, you are required to split the instrument as liability portion and equity portion. So present value of obligations you have to pay will be treated as liability. The remaining portion will be treated as equity. So compound instrument, your fair value of instrument at the time of issue minus the value of liability, the difference will be treated as equity component accounted as part of shareholders' funds in your balance sheet. So this is in a statement form. Commodity contracts, I've spoken about it earlier. Treasury shares, as far as treasury shares are concerned, the Companies Act in India doesn't allow you to hold. But let's say I bought back some shares and cancellation is still pending. So those cases, the shares which you bought back, where cancellation is yet to be done, the standard requires you to show it as a deduction from shareholders' funds. You cannot carry it in the balance sheet. You should show it as a deduction from shareholders' funds. Now comes impairment accounting, followed by hedge accounting. These are the two important parts which are left out. And I will cover these two tomorrow. I'll cover these two tomorrow. So let me halt here. Any questions on the discussions for today, I'll address here. On impairment and hedge, I'll address it tomorrow. So over to you, Mohit. And
thank you. Thank you, MP sir. Yeah. Friends, if you have any question, kindly write in the chat box. Friends, if you have any question, you can write in the chat box.
Sir, I have a question. So this is Hemant Lakutia, co-chairman of.
Hi, Hemant, please.
Good evening, sir. So my question is, sir, so when we are classifying debt and equity, so if there is a company which has issued compulsory convertible debt instrument, however, the conversion, the number of shares have not been determined on the issue date. It will be determined, on the date of conversion based on the EBITDA multiple or XYZ factor. So again, here we are not, so there is no the 1-to-1 which we say that right. So will this be classified as debt or equity?
Liability, financial liability.
Liability was saying.
While it is tempting to treat it as equity, Hemant, because we know money will not be repaid. But we have this expression which I told multiple times, fixed for a fixed.
Fixed to fixed, yeah, right.
Amount fixed, quantity fixed, only then equity. If any of them are variable, then it becomes a liability. And many clients keep pushing back as to why are you treating it as liability. The answer to them is, you are actually receiving money now in advance for something to be transacted later.
Correct.
So consequently, it's a liability. So that's the way to explain to them. And I know clients keep pushing back and saying that treat it as equity.
Correct.
I hope I have answered.
Right. Thank you. So, Vivek, you are on mute.
Thank you, sir. Thanks a lot. Yeah. And sir, one more thing, there's always a big doubt. The difference between, say, a 0 coupon bond and the bond having 3 or 4% coupon with a convertible option. So when it becomes a hybrid and when it remains as equity, there's always a big question people keep on asking.
No,
for the public at large.
These are compound instruments, Vivek, because they're not issued at market rate of interest. So there's an equity element which is there. So what I just mentioned a little while ago. So I raised 1,000 rupees. The present value of liability, which on market price basis is, let's say, 700. The balance 300 will go as equity. Equity means it will appear as part of SOCI, Statement of Changes in Equity, as one of the reserves.
Thanks a lot, sir. Thanks a lot.
So, but 1 minute. So to add to this question, so if I'm issuing a 0%, bond debt instrument, and there is an option of conversion in the hand of the issuer.
Yeah.
So will that be classified as debt or equity?
Same logic here also. It will still be a compound instrument, because as a company, you still have a liability in the form of the market rate of interest, which you would have otherwise paid. So that breakup has to be done.
Thanks.
So one more person raising hand.
And Nilima ji, I thought you raised your hand. But the hand was... Nilima ma'am, you have any question? Okay. Friends, anyone having any question, they can unmute themselves or write in the chat box. 2 minutes to go. So I would take this opportunity because we will have the slice of the cake tomorrow also with MPV sir tomorrow. Friends, as sir was saying in the starting, we kept on saying 50%, 75% of the total IFRS. But sir has made it so lucid, MP sir has made it so lucid that it's just superb. Yeah, Pratik, sir, you can unmute yourself and ask a question. Pratik ji, do you have any question? You can ask a question. I think by mistake he has raised it. So as I was saying, you have made the session so lucid and so simple. We all were like having a wow feeling. So with that, I would say, yes, friends, it's correct. If we take a subject to be heavy, we will not be, we would be running away from it. And as Sir started by saying it's of about 900 pages documents, we try to run away with the 200-page explanation guide or 200-page guidance note. But I would say, being part of AASB and ASB for last 2 years, it takes lots and lots of pain of the secretariat and the chairman, co-chairman, and all the study group members to make that document. So please don't run away with the document. The institute is working very hard to make those documents and read it. There's a very good explanation guide on Ind AS 109 and financial instrument, and a very lucid book also. So tomorrow I'll be sharing the link of that book issued by ICI. You please go through it. You'll enjoy. And then what Sir started saying, that you will feel it's like a cakewalk. We have been made afraid because we keep on making our clients afraid so that we get a better remuneration. So we become afraid in that vicious circle.
Vivek, just a second.
Yeah.
Vivek, just a second. There's
Yeah.
a question from Govindan.
Yeah.
I'll just respond to him. Example of debt instrument measured at FETPL, I guess is referring to a financial asset in the form of a debt. I'll cover financial liability also. Financial asset held as, I've invested in bonds, I've invested in debentures. There is specified payments of principal and interest. So it is passing the contractual cash flow test. But the same investment in debentures, but the same investment in bonds, scenario one, I may have intent to hold it till the last date, amortized cost. Scenario two, I may have intent to hold it as long as possible, but if opportunity comes, I want to sell and realize, that is fair value through OCI. Or third situation, neither of these, I'm undecided, unclear, designate at FETPL. But here what is important is, let us take a situation where I have a behavioral pattern. I have a behavioral pattern where I keep buying and selling bonds regularly. Then it will automatically go to FETPL because the evidence is that I'm not holding at all. Recall first scenario, hold till maturity. Second is hold it and then sell. So behavioral pattern, I'm buying it for selling in the near term, in the short term. That is one behavioral pattern, FETPL. So same debentures bonds. If I'm managing it as a portfolio pool, I bought some state government bonds, some central government bonds, some public sector bonds, some debentures. I'm managing it as a pool. I know some AAA bonds, some AA bonds, some BBB bonds. As a pool, I'm managing and I want to get 9-10% return. So that again is a behavioral pattern. If that evidence is there, treat it as FETPL. Treat it as FETPL. Third is, I have decided I don't want all of this headache. I want to keep it as FETPL. It goes as FETPL. So that is the example of debt instrument, which will go as FETPL category.
Perfect,
On the liability side, also, there can be a debt instrument which can actually qualify as FETPL. This is not what you and I will see in day-to-day life. This typically comes in banks, global banks and all. Indian banks and all, RBI doesn't allow. So in global banks and all, so they could do trading on liabilities. I can issue some bonds. I know the interest rate movements in a particular manner, redeem those, replace with other bonds. So those kind of trading activities I may do on the liability side. Just like on the asset side, I buy and sell. Here I issue and redeem. they will go as FATPL category. But liability side, you will not see that often in the Indian context, or rather, at least I have not seen till now anybody in Indian context attempting the same. Govindan, hope I have clarified to you.
Yes, sir. Thanks, sir. Yeah.
Pratik, I see your hands up again. Would you like to ask something? Otherwise, we'll hand it over back to Vivek. Over to you, Vivek.
If you have any question, kindly ask the question. You have raised your hand. I think he has some audio issues. Anyhow, sir, thanks, and thanks for repeating this, what you were saying again about a very good question. And we can also think of bridge financing, where we can go for fair value to PL, where it's a 1 day, 2 day financing, or we do the liquid fund parking for 1 or 2 days, that we can go for fair value to PL.
Yeah.
So that was a fantastic session. And since we are not ending the session today, we will be continuing the session tomorrow. So with this, I would request co-chairman Hemant Lakhotia ji to please give a formal vote of thanks to sir.
Tomorrow, what time, Vivek? I'm sorry, I didn't calendar is actually.
It is from 5 to 7 actually for yours.
Same time. Okay.
Hemant ji.
Yeah. Thank you, President. Thank you, MP Vijay Kumar ji, for taking out time for ACAE. Sir, it is always nice to hear from you on any topic, be it accounting standards or valuation or any other subject. So when we look at the Bear India's financial instrument, at times the language seems to be very technical and maybe difficult for many to understand. But the ease and the simplicity with which you have explained us, taken us through the standard is really commendable. I mean, this would really help to all our participants, and we can always refer the recordings for our future reference. Thank you, sir.
Thank you, MP sir.
Thank you.
We at Calcutta or we at East will never let you go alone. We'll be always there with you as we were there in pandemic.
But Vivek, you won't believe I've done the maximum programs for Eastern region.
I know, sir. And friends, with this important session of financial instrument, I would like to inform you all that ICAI has come out with 23 forensic accounting standards. So kindly go through those standards. There has been really very hard work, and we are the first organization throughout the world coming out with this standard. Although some people say they are standards, but those are of 1 page or 2 page and not a complete set of standards. ICAI is the first body to come out with the complete set of standards. And please refer to it, because this pandemic has acted as a catalyst to give a growth to information technology. And we see forensic will be there to stay. Maybe stat audit for small companies or internal audit may move away, but forensic will be there. So we had a very good workshop. If you all want, you can watch our ACA channel. And we had a workshop with Mr. Chetan Dalal, Sandeep Baldeva, Durgesh Pandey, and Deepa Agarwal from AASB, who was speaking about the fraud reporting. So requesting all of you to do visit our ACA channel. And there are around 300 videos. And I have also shared the link of Sir's workshop, which was held some months back on Companies Act, which Sir was talking. So thanks a lot for joining. Ending the meeting over here. And sir, thanks again. Tomorrow, 4 p.m. sharp, we'll start with the disclosures, and thereafter MP sir continuing with his session.